and Josh is going to introduce our speaker of the evening.
All right, sorry. And I had a couple of requests about recording the presentation, and I just pushed record. So as of now, it will be recorded. I know that everyone saw Ed. Ed's the first person to provide 2 bios for you to read. So that was awesome. But just a little bit about Ed. Like I said, I've had the opportunity to be in a couple different presentations with them, discuss a couple of cases, things as complicated as charitable LLCs. He knows a ton about charitable planning, but I'll read a little bit about Ed. Ed Cotney helps families pay less tax and enjoy more life, guaranteed. Ed graduated from the prestigious professional mentoring program in Franklin, Indiana, where he became a family wealth counselor in 2000. He received his certification as a philanthropic developer in 2001, and has a certification as a business exit planner as well in 2019, working as a strategy and tax designer at 3 law firms over the past 20 years. He's applied his practical knowledge to help families and business owners implement planning strategies to reduce income tax or eliminate capital gains tax upon the sale of a business or highly appreciated assets. His academic and work experience can also be found on his LinkedIn profile. So without further ado, Mr. Ed, all you.
Well, good afternoon, everybody, and thank you for this honor to share with you this evening. And I just want to tell you how great the dinner was. The chef did a wonderful job. But a couple of stories real quick before we get started. Liz and Andrea, the only reason I'm alive is because of my doctor. 2014, I went in for my annual flying exam. I've been getting a flying exam since I was 18 years old. And my doctor said, the test results look weird. Let's do them over. And we did them over. And sure enough, something was wrong. And I am a living, walking dividend because of the American Cancer Society, the American Heart Association, and also the Sutter Health Hospital System here in the Sacramento region. So I'm a big fan of people promoting ways to raise monies for linear accelerators and everything else. I lost 2 years of my life to cancer, but I'm walking proof that it can be done and you can be saved, and 13 doctors and countless medical people and tons of equipment saved my life. So thank you very much for the work you're doing at Santa Rosa Medical. Tonight, I want to talk about how easy it is to raise money for charitable causes. Usually that's met with, are you kidding me? It's easy to raise money for charities. I'm on a board at a charity. We're always trying to raise money. It's like, how do we raise more money? It's like the #1 thing we talk about all the time. I think for me, the turning point was when we got to a position of helping people understand how to profit with charitable giving. And so tonight, that's what we're going to do. And Josh, I'm going to go ahead and share my screen with the group to make certain everybody can see this. And so we're going to transition to a big white PowerPoint screen. Can everybody see the white slide? All right, so here we go. We're going to cover a lot of ground. There will be a 50-question test at the end. And if you pass, you get to go to sleep. If you don't, you get to stay for another hour of continuing education tonight, okay? Is that a fair deal? All right. All right, I wrote a book about tax planning while I was basically dying of cancer, but I'm not here to promote the book, but I want to talk about John and Mary Smith. They're our clients. They're 65 years of age. They have a business that they're getting ready to sell. It's an S Corp. They're the only 2 shareholders. It has a $500,000 basis in it, which is kind of high, but I use round numbers so we can learn faster. They also own the building. It's a $5.5 million building value with a $500,000 basis. Basically, we have an $11 million transaction here with a $1 million basis, a $10 million gain. They're in your office, and this is what they're asking. And this is tough to do, but I want to show you a couple of ways to help people get open to the idea of doing something and why. When we look at business owners, I should say, they do these studies every year to try to determine who is going to sell their business, when and why. And so when we ask the client, when are you going to sell your business? Are you planning to sell your business? I mean, what's your event horizon line? And this is kind of the numbers that we get from the group of people that answer. And so the thing that's interesting here is that we always end up with about 9 or 10% of the respondents saying that they're never going to retire. So I guess my question to those people are you just going to die at work at your desk? I mean, what's the story here? But we all realize that all business owners are going to leave their business in some form or fashion, either in control or not in control at some point, either by dissolution, divorce, whatever. They are going to leave that business somehow, some way. When I meet with business owners and we start talking about their exit, there's 5 critical elements that I think are really crucial to having a successful exit plan. And one of those things is, when do you want to retire? That seems to be the primary question that people ask all the time, is when. I'm not comfortable with that. I think when is an important question to ask, but I think another important question is, why are you working if you've made more money than you would ever need for your financial independence as you believe it to be? I mean, how many times do we meet with a business owner and say, when do you want to retire? Well, when I have at least this much money so I can have this much income for the rest of my life. 3 to 5 years later, we meet with the client. Well, I've changed my living style and now the business needs to be worth X because I need this much money. They seem to never do this. One thing that I try to help business owners understand is that when the day gets here for the transfer of their business, it's probably not when they thought it was going to be. So my best advice to them is, run your business like it is for sale every day. And when we look at the number of unsolicited business offers that we have today for business owners who are not prepared to go to market, who don't have the highest multiple, their EBITDA has not been polished, they don't even have reviewed financials to even point to, I really think that it's a disservice when we try to help business owners not realize the importance of running their business like it's for sale every day. We have $2 trillion in private equity money sitting on the sideline that has not been able to be deployed in the last 18 months. The pressure that these private equity companies are under right now to deploy that money and buy businesses is tremendous. I'm seeing offers for companies with multiples that I think are ridiculous, but that money's got to be deployed. And those business owners who are in the right place at the right time with recession-proof businesses today, that door is being knocked on about every 5 minutes with somebody with an offer to buy it. So departure date, yeah, for planning purposes, yeah, I want to retire when I'm 65. Okay, but maybe we should plan for selling the business when conditions are right. The next thing is some form of preliminary financial needs analysis. I mean, how much is enough when you do retire? I mean, do you have a window for that? Another piece of the discussion is, who is going to buy the business? Is it going to be a transfer to a family member or a key employee or a key group of employees or all the employees? Or is it going to be a third-party sell? Statistically, we see most business owners would like to see 2/3 of the time an internal transfer. The reality is 2/3 of the time or more, it's an external third-party sell. Most business owners don't have any idea what the business is worth. Every now and then it'd be a good idea to spend a couple of bucks to find out what the business is worth. And then also looking at cash flows and those types of estimates from a perspective of what makes sense to qualify for a loan, taking the business to market, etc. So I'm just suggesting that anytime we can help that business owner entertain the question of, is your business ever going to be sold for the highest possible multiple? Then my question becomes, what steps are you taking to make that happen on your terms, okay? I did a presentation like this recently at William Jessup University. And after the presentation was over, the group was primarily business owners, attorneys, accountants, professors, plan giving. It was a great mix of folks. But we sent them a survey electronically and asked them to rank in hierarchy, what are the things that are important to them? And of the 9 items, this is how they ranked it. Income tax planning was their hottest button. Okay, wow, what a surprise. I think that's everybody. Followed by retirement planning, estate planning, exit planning, value building, EBITDAs, buy-sell agreements, team building. And I got to tell you, the thing that bothered me the most when I see what my business fees are every year, CEO coaching was at the very bottom. So from a priority perspective, I get it. hot topic is always income tax planning because cash flow is king. But I truly believe business owners, we need to help them move up the scale a little bit to understand the value of building an A team, making the company profitable, proving it on paper, and having it polished at all times. So basically, business owner objectives: staying profitable, happy, productive employees, access to capital to grow, low income taxes, wow, what a surprise, trying to be litigation proof as much as we can, with a goal to retire in style. Yeah, there's one thing to retire financially right, but it's something else in reality. So these are pretty much the simple business exit objectives: right buyer, price, terms. The employees are somehow handcuffed to the business so that the buyer doesn't have a hard transition and the business moves forward. Here's where we advisors can really bring value to the client. What does retirement really look like? I mean, you can only play golf for so many days after you retire. I mean, after 6 months, it's pretty much over and done with. What does retirement really look like for these folks to have that conversation, to start talking about what are your new social and your new emotional and your spiritual objectives going to be? This is an area of discussions where most of us freak out when we start talking about these issues in front of the clients, because we advisors find safety in numbers. We find safety in a buy-sell agreement. We're comfortable there. But the reality is, for that retiring business owner, they need somebody to help them talk about these social, emotional, spiritual issues, because that's one of the primary reasons they're scared to death to sell their business. They're selling their attachment to everything that they know. They gave birth to this thing. And so it is a hard disconnect for that business owner to walk away from these businesses they've owned for 10, 20, 30 years. So I would suggest you try to open up that door a little bit on these social, emotional, spiritual things to start discussing about that retirement lifestyle, because it leads us into this point. What's the purpose of their life, their wealth, and their money? We like to talk about estate tax planning all the time, and even legacies to some extent, but what was the real meaning of their life? I mean, what is their purpose? So the value add as an advisor is asking the right questions, which are often the hard questions. Talk about more why questions. Why do you feel that way? Why is that important to you? And how do you really feel about money? I can't begin to tell you the number of families that I've spoken to over the years where they feel guilty about the money. They're not comfortable with it. They want to find a way to relieve this guilt. So how do they feel about this money? And another question that a lot of the estate planning attorneys are hitting that I just love is, how much is enough to leave your children? Followed by the most important question, I think, is how much is too much to leave your children? And what are the ways to design the estate plan in such a way that we safeguard the children from themselves and external factors, creditors, predators, those types of things. I had a meeting with a gentleman here in Sacramento with about 1,000 employees about 3 months ago, a business member. And I was invited in last minute. I had no idea what I was going into. The only thing that I knew was the question is, what do we need to have prepared for you to meet with us today to talk about our tax problem? And I'm like, okay, if you at least have the last 2 years of tax returns on the table, I can flip through a few things and maybe point out some things we can do. So I arrive at the business, which was humongous, which I was not expecting. I go into the conference room to meet with the business owner and his CFO. Huge conference room table there, and nearly 4,000 printed pages of tax returns laying on the table the last 2 years. And I'm like, oh my gosh. I kind of felt bad. I'm like, well, I at least need to flip through some of these pages here to make them feel like I've done something right, So I started flipping through pages and looking at everything. And here's a guy who had, after all deductions and everything, he had a reportable AGI of a little over $14 million. And he was upset about a $6 million income tax bill, which had been the norm for the last several years. And he's like, why am I paying so much in tax? And I'm like, well, you made a lot of money. This is how it works. You're doing the captives, you're doing all these other things, which is great. But there's a point where all those things above the tax line, your CPA is done with ideas. And he's sitting there nodding his head. Yeah, I've done everything I can do. And then I looked at his charitable giving, $17,263. He made $14 million. He's complaining about a $6 million income tax bill. His net worth is in excess of $250 million. He's the poorest of his three siblings, and he gave $17,000 to charity that prior year. And I'm like, you know, partner, you're missing the greatest thing in the world here. You have all this money. You don't have a way to use it. If you die today, the IRS is going to be taking over 40% of it anyway. Why don't we just start doing something philanthropic with the money? And he said, like what? I'm like, tell me, what do you think is the most important thing that you could change today? If you had $2 million to give to a charity, what would you go help solve? And he immediately responded with the homeless issue. We have a horrible homeless problem here in Sacramento. And I'm like, if you want to get my attention, I need you to just get out that checkbook and stroke a check for $2 million and let's go find a charity. So we finished the meeting, and I'm pleased to say that the following year, he gets recognized with a huge award for his philanthropic donations and his commitment to solve the homeless problem in Sacramento. My point is this: he'd never really been stood up, is what I would call it. And that's what he told me later. He said, no one had ever stood me up like that before. I'd never thought about the fact that I made more money than I'll ever need in my life. And I could save some problems, solve some problems, and save some tax money. Now, giving $2 million, is that a profitable thing for him? No, it's still going to cost him $1 million, but it began the conversation for him. Okay. So what's the most important thing that people can solve? And I would ask you that when you start looking at your tax returns every year, when you look at the money that we're giving to the IRS charity and the Franchise Tax Board charity, if I could show you a way to profit instead of giving monies to the IRS and Franchise Tax Board charities, but to local charities doing great work, hopefully I can get your consideration. I'm asked all the time, you know, what are the parts of these fancy dancy tax strategies that I put together? And so I thought long and hard about it. And I put together this really complex diagram that's going to show you the three most important pieces of a complex, sophisticated tax strategy. It typically involves a charitable thingy, a trust or business thingy, and an insurance thingy. That might be a test question. People don't need to worry too much about what the structures are. They need to know the benefit and the impact of what we're trying to accomplish, which gets us back to, if we've asked the right why questions, that means when it comes time to start talking about, we need this family limited partnership along with an ILET, and we need an equity-based portfolio, and we need a second to die policy and a first to die policy. And that's our world. For them, they just want to know, does it make sense? Are we going to save money, make money? And what's going to be the impact of the value that we bring to the table? So I show this cartoon all the time. Have you ever had a client come into your office complaining that they did not get to pay enough income tax last year? Well, we all know better. And I ask this question all the time: will income taxes rates go up, down, or stay the same? The answer is yes. It's a moot point. It doesn't matter. I speak a lot across the country, and people always, oh, golly, our taxes here in the United States are terrible. If you can see the slide compared to other countries, I got to tell you, we've got it pretty good in this country as far as our tax code goes, particularly when we got 80,000 pages of loopholes to work with. There's a lot of other countries that's far worse than us. One thing that people do kind of collect on in respect to learning is that the effect of taxation and the erosion. So what if I told you that I have an investment where if you gave me $1 today, I will double that dollar every single year. $1 today is going to be worth $2 next year. Oops, 40% tax bracket haircut. Then I got $160 to invest. Now it's worth $320. Oops, 40% haircut. Over the course of 21 years, my $1 with a doubling effect annually is $139 basically in my pocket. Whereas if I never get a tax haircut with deferred tax growth, this is why people fall in love with IRAs and 401ks and things like that. Yeah, that deferred hockey stick down at the very end in years 16, 17, 18, 19, and 20, that $1 really becomes attractive. So in my book, I write about rich people are good at making money. Wealthy people are good at making money and keeping more of it. There is a difference between rich and wealthy, and that's how I define it. When I look at our confiscatory tax system, we all understand that this is what I can keep to enjoy from my personal wealth, and this is what I shall surrender in the form of income tax, capital gains tax, maybe a gift tax if somebody gave me too much too fast, or an estate tax because we died too wealthy according to whatever the IRS deems to be wealthy that year. It's this simple. It's kind of a split. And I think we all know the tax rates based on TCJA. We've got some pretty significant standard deductions to work with, which for many donors in the nation who are normal people, many of those folks who made gifts of $1,000, $5,000 to their favorite charities really didn't get to itemize that benefit because their standard deduction was higher than their Schedule A could turn into. So under TCJA, these are significant things. The question we have under the Biden Tax Act is, will they keep the same standard deductions or not? That's something we got to be ready for into next year. We have very generous capital gains taxation. Gift tax is very, very good for the annual giving of 15 per year. And we have probably one of the highest lifetime gift estate exemptions we've ever seen. Everybody in the business knew that this $11 million thing was not going to last, and it didn't matter who the president is or is not. The number, one of my friends, Robin Clarence, is a tax attorney who goes to Washington all the time. And we were on the phone the other day where she was laughing at, we never thought we would see $11 million. It was really just kicked out in the Senate, and the next thing you know, it got approved. Here's a disadvantage of doing Zoom versus being in person. 60% of income tax is optional. 100% of long-term capital gains taxes are optional. 100% of estate taxes are optional. And usually when I'm in an audience, I can see people looking at me, particularly when I was at William Jessup University and I threw that slide up. It was like a lightning bolt from heaven was going to strike me down there on the Christian campus at the university. With proper planning, these are optional, and there's so many ways to make cap gains and estate taxes optional and controllable, but you have to be proactive. You have to get off your butt. You have to go see professionals who are trained in knowing how to do this. And I was pleased to hear many of you talking earlier today about doing GRATs and CRTs and ILETs and those things. I'm like, yay. I mean, that stuff is coming back. When we look at the professions of all of us, the reactive tax planning tends to be where the bread and butter is. It's the things that we do for our clients to claim what they can claim to get their AGI down. And for business owners, those things stay pretty generous. But under TCJA, the W-2 1099 wage earner, they pretty much lost the bulk of their deductions, and it has not been a friendly thing for most of those folks who make more than about $250,000, $300,000 a year. Compared to proactive tax planning, where we start doing things beyond a cash balance program or deferred comp, we start looking at R&D tax credits, which are gainfully coming back into more knowledge, which I'm glad to see. We saw some very generous cost segregation study rule changes in the last couple of years, which may not last past 2023. Exporting stuff overseas, I think, is still one of the quiet little tools that many people overlook. Work opportunity credits, new employment tax credits. Some states allow you to buy and sell transferable tax credits as an effective tool. And one thing we're going to touch on pretty hard tonight, which is one of my favorite things, is charitable retirement planning, because I think you will see in our case study, charitable retirement planning will blow the doors off all other types of planning we could do for this family. Insurance tax planning, I think, is woefully misrepresented. It is something that most people just don't understand. And it's kind of amazing where people just think about insurance planning as, well, it's a way to cover risk. Yeah, but when properly structured, it's a powerful zero tax income play. So 80% of the time we spend our time over there, and maybe 20% of the time advisors tell me they get to play over in that area. So I did a seminar in the South Bay about 4 years ago, and this is the phone call I got shortly after that. Ed, we saw your seminar 2 years ago and loved it. We're selling our business in 3 weeks. We have a $12 million tax bill staring us in the face, and we need you to come fix it. I'm sorry, I can't fix a $12 million tax bill in 3 weeks. I mean, purchase agreement's done. I mean, everything's done. So the one thing that I would encourage you to be really paying attention to with your people who are selling businesses or 300 acres to Walmart or that 400 apartment complex building, to always be putting in their ear, proactive early planning is the thing that gives you the greatest control and greatest flexibility to get the greatest results. This last minute, we have a tax bill, come fix this in 3 weeks. It is just not. And this is what I hear from the business owners. They're always complaining about we pay too much in tax. Okay, well, that's normal, I think, for a business owner. But I do think that a lot of our business owners don't get the full service they deserve. We're great at preparing the returns. We're great at declaring what we can, but that proactive piece, sometimes they're just not getting it. So is there a better way, as we say in Alabama, roll tide? And by the way, Res Demisphere is from the University of Alabama. Yay. So I'm glad to hear you guys have plenty of it down there in Santa Rosa. So what's the purpose of our government taxing us? It's a way for the system to take money from events like income, cap gains, etc., and distribute it to the nation in such a way to take care of the country, to pay for roads, to pay for government, to pay for military, to pay for welfare. It's social capital. That's my argument. Tax is nothing more than a tool to take care of the social needs of the nation. And so when I pay $1 of income tax to the IRS, we typically have about a 27% effective impact of my income tax dollar hitting the street to do something. That means nearly 73% of my income tax dollar evaporated in fraud, waste, and abuse, budget deficit payments. In other words, if I were to run my business with the same effective utilization that our governments use in collecting their revenue from us, I would be out of business. So I'm not trying to say the government's terrible at running a business. I'm just saying that when it comes to an impact of my dollar, I have to accept the fact that 27% of my income tax dollar does something. I got to tell you, at my house, I work hard for my money. And it really bothers me to see so much of my money not being deployed in a way to help this nation be better. Conversely, when I give $1 to a charitable organization, such as the Santa Rosa Memorial Hospital, something tells me that 80 to 95% of my dollar is going to be effectively applied. I got to tell you, when I give $1 to a worthy charity, I feel real good about the fact knowing that the money that I work so hard to give away has an impact that's significant as compared to the impact that my income tax dollar has to do under a compulsory taxing system. So I want to move your cheese a little bit tonight to talk about this issue of charitable receptivity. The bulk of the nation is open to this charitable discussion. Yeah, we do have about 20% of the nation that doesn't have a philanthropic bone in their body. I mean, there are people out there who could care less if mom is in the line at the soup kitchen. They're not going to donate a single dollar. I get it. But the bulk of the nation is open to this discussion, especially when you can show them how to profit off of a charitable gift. Now, this is my church back in Dadeville, Alabama. It's Mount Carmel Baptist Church, and it's one of the few times that it snows really good down there. It doesn't really snow very much, but when we get 2 or 3 inches of snow, it is a disaster. But this is the church that my great-great-grandfather donated property to have built back in the 1800s. And if you see to the far right of the picture, there's a little white door and then 2 little windows down there at the bottom. Well, the way it worked at our church is you got there before 10 o'clock in the morning on Sunday. and you would be admitted in, and you'd get the little fan in the summertime, and you'd have things like that, because we didn't have air conditioning back in 1965 when I was 5 years old. And so after the church service began, they would break us up into groups, and the little kids would go downstairs to the basement. And downstairs, my Sunday school teacher was Miss Margaret Keith, God rest her soul. And Miss Margaret Keith would give us a Sunday school lesson. Toward the end of the lesson, she would hand out these little white envelopes. And 5 years old, we're trying to write our name on it, and maybe we could stick a dime in there or something. You got to keep in mind, if you gave a dime away on Sunday, a dime back in 1965 bought a full-size candy bar that cost like $3 today at the 7-Eleven store. So we'd stick that dime in the envelope, and we'd write our name on it, and we'd lick and lick and lick. And that lick in the envelope was like the best part, when you're 5 years old. And then after Sunday school was over, we'd go up to big church, and the offering plate would come around, and there you are with your parents, and you would put your white envelope in the offering plate. And sadly, I got to tell you, I truly believe this process of giving, where we teach people to give cash, we taught the entire country how to do it wrong. Not that there's anything wrong in giving. It's just that from a tax efficiency perspective, I want to make the argument tonight that there's a better way. I want to use $1 million of adjusted gross income for our donor. The CPAs pulled out every miracle known to man to get that AGI down as far as possible. And so I want to preface this as a trick question. This is a trick question, mind you. What is the maximum amount of money or assets that a person can donate to charity each year? The donor made $1 million. What's the maximum amount of money or assets that they can donate to charity? There is no limit. There are limits on how much they can deduct. Under normal rules, and remember we do have this exception this year where we can give cash to public charities up to 100% of our AGI on the federal side, but normally it's capped at 50 or 60% under TCJA, Schedule A, line 11 for cash. And then if we give securities like real estate or publicly traded stocks, there's a 30% rule. And so under Schedule A, line 14, if our donor were to write a check to the Santa Rosa Memorial Foundation for $50,000, and let's just make the math simple. They're in the max federal tax bracket. They're in the max California tax bracket. It's like 46, 47, but let me make it 50 to make the math easy, because remember, I'm from Alabama, 2-digit IQ. I've got to make it easy to learn and teach here. $1 million AGI, we get 50,000 cash. Technically, that buys me $25,000 of tax savings, because my new adjusted gross income is $950. Is everybody kind of okay with that? Give me a thumbs up to make the math simple. We're good? All right. Here's Schedule A, line 14, blown up. Cash, 11. 12 is stocks, carry forwards, line 14. In my opinion, Schedule A, line 14 is the most underused, most powerful tax planning tool we have at our fingertips. I can do more with that line than practically anything else in a tax return to make a client happy. Here's Schedule A numbers come over to page 1 of the 1040, which is over here. Look at item 12, which is your standard deductions. And of course, if Schedule A is larger than the standard deduction, we would put the number there, which translates into reducing the AGI. That's as deep as I want to get on tax returns. God bless America. All right, let's do more with the taxpayer. Let's build a legacy with this person, and let's make some money doing it. So let's shift the paradigm thinking here just a little bit, and hopefully this makes many of you uncomfortable. 5 years ago, I had $40,000 burning a hole in my pocket, and I went out and purchased 4 investments at $10,000 a piece. Over the last 5 years, one investment grew to $110,000. One investment grew to $90,000. I call those racehorses. They're the perfect type investment, whether it's real estate or stock. It's lovely, it's growing, it's wonderful. I was a genius. Now, one of the investments started out pretty good, but kind of plateaued about 2.5 years into the time. And even though I started out with $10,000, it grew in value to $50,000. When I look at the lost opportunity cost on that money for the last 2.5, 3 years, it is a real number, isn't it? I also realized that if I sell that $50,000 position, I have a $40,000 gain recognition. So that's another taxable event. You know what? I think I'll just sit on that stock. And any day now, it's going to have the hockey stick thing where it's going to turn into a racehorse. In any minute now, it's going to be a racehorse. Yeah. So I call those donkeys. They're unproductive, highly appreciated, poorly performing positions. And then one position is just a rock. It's still $10,000. But again, it was a hot stock tip from my uncle back in Alabama. And any minute now, it's going to hit as well. I'm certain none of you have clients like this. The reality is we have tons of clients like this. But for that client who made $1 million, maybe we should introduce him to a thing called charitable tax harvesting. Charitable tax harvesting. And here's how this works. When I show the donor a Mo Better way, again, University of Alabama Roll Tide, a Mo Better way, if we gave $50,000 cash, I buy $25,000 of tax savings. If I give that poorly performing stock asset that I have, the donkey, which has a basis of 10, using the same tax rate, I still secured $25,000 of tax savings in respect to reducing my AGI, didn't I? There's no difference here. There is a net profit, though, of $15,000. And this is where people go, what do you mean? The difference between the stock and the tax savings. I bought $25,000 of realized tax savings for $10,000. If you don't get this step right here, I'm going to totally waste your time on the rest of this presentation. The reason this is important is because now the donor, instead of giving the $50,000 cash to the Sonoma Park Foundation, I'm putting a plug in for you there, Melissa, because I was down there at Westside Park a couple weeks ago. Give the $50,000 cash to the stockbroker, have the stockbroker give the donkeys to the charity. The charity doesn't care if it's cash or stock. They're still going to convert it to cash. They still have $50,000. The donor still has a $50,000 deduction on their tax return. The donor still has $25,000 of tax savings. The donor netted a $15,000 profit scenario here because we got rid of the donkeys. And the donor now has $50,000 of new cash in the investment portfolio to hopefully buy new racehorses, which does increase the AUM for the financial planner. Everybody here wins except the IRS. This one little technique right here will change the dynamics of practically every conversation you will have with that client when it comes to taxation. How much can I put in my IRA? How much can I put in deferred comp? How much insurance makes sense? This conversation will open that door to the social, emotional, and spiritual things that are so important to the conversation and the relationship with the client. Anytime that I show somebody how to make money off the IRS, I become their most trusted advisor. So why is this important? Well, let's get back to Mr. and Ms. Smith. I'm basically teaching a way to do engineering for social entrepreneurship. I'm changing the way they think about personal capital in a confiscatory tax system. And what I'm trying to do is teach them how to convert as much of their social tax responsibilities into blessings for worthy causes. Yeah, we still have some tax along the way, but if I can put more money in their pocket, put more money in charities' pockets and less in the IRS, that's what I call a victory. That's what makes me go do what I do every day. That's why I get excited and passionate. And that's why I'm for a Southern country boy with a 2-digit IQ. I love this stuff because I can dumb it down and make it simple for people to understand. One other thing I want to talk about before we get into the case study for the Smiths, people get confused with the term a current gift deduction versus a deferred gift deduction. Real quick, I give $50,000 to the Airplane Museum. I get a current gift deduction because the charity has the $50,000 in their possession. I put $50,000 into a charitable gift annuity at the hospital, I'm not going to be able to get an income maybe right away, because my favorite thing, by the way, deferred flexible charitable gift annuities, in my opinion, is the greatest thing we've ever had with charitable gift annuity designs. I just love that thing. The deferred flexible charitable gift annuity is just a hammer that works for practically everybody, regardless of their wealth. Anyway, it's a deferred gift, which means the charity's not getting the money till a lot later, which means my tax deduction is discounted. And I had a question a couple of years ago where somebody said, Ed, why are these CRT gifts, monies donated to a charitable remainder trust, different for a person who's 55 versus a person that's 65? It's real simple. The guy that's 65 years old who made $1 million cash gift to a charitable remainder trust, the reason he gets a $600,000 deduction instead of the lady that's age 55, she only gets a $321,000 deduction, is because the guy that's 75 years old is closer to getting to meet God. His CRT is not going to last nowhere as long as the lady with a 55-year-old CRT. So hopefully that helps you understand why these charitable trusts have these calculations to determine what the tax deductibility is, because there is an age component on how long the trust is going to run. Now let's get into John and Mary Smith. Remember the corporation they have as the two shareholders in the building they want to liquidate this year? Well, let's figure out what the tax bill is if they do nothing but just sell, like so many people who have the right to overpay their tax. There's no law against paying max tax. So here is the operating business. It's an S Corp. It's going to be an asset sale. We have a gain of $5 million. I'm using 33% as a simple number. The tax bill is going to be 1.6. John and Mary are going to go home with $3.8 million after tax on the sale of the S Corp. In respect to the commercial building, 5.5, adjusted basis 500, $5 million gain. I'm going to use 40% here because they also did some depreciation recapture. Tax bill due is $2 million. Net of all of this stuff, close the transaction, they go home with 7.3. IRS and Franchise Tax Board goes home with 3.6. Okay. Nothing wrong with that. You have the right to do this every single day like that. But when I look at $3.6 million leaving Sonoma County, something tells me there's got to be a better way to keep that money around somehow. So I've used this concept just to make it simple to understand and to show you the power of just using a couple of tools. We're just going to sell the business outright. There's not a lot of things you can do with a business in respect to using a charitable planning structure, because there's a couple of big court cases out here involving the prearranged sale rule, which is the Palmer case and the Ferguson case. Be very, very careful about prearranged sale rules and then putting an operating business which triggers unrelated business tax into a charitable structure. Lots and lots of issues there. Even though the IRS did grant a private letter ruling of putting an operating business into a charitable remainder trust just a few years ago. So it can be done. It's just tough. Let's put the building into a charitable trust, just your plain old vanilla 2-life charitable remainder unit trust. And basically a big fat gift goes to charity when they die. So we know that with no tax planning, they go home with $7.3 million. And we take the money and we put it into a 6% portfolio. Their life expectancy is 30 years. Okay, the computer's going to tell us when they're supposed to die. So we have the corporation, it has a $1.6 million tax bill, but we put the building into the charitable trust, which creates a $1.5 million deduction. Oh my gosh, over the next year or two, I can probably use the deduction from the charitable remainder trust gift to offset the tax bill from the sale of the S Corp, which means at the end of the day, we have $11 million to be managed at 6% with $660 million combined income. Simple question here for Mr. and Ms. Smith. Do you want to do no tax planning and live on $441,000 for the rest of your life? Or do you want to do this charitable remainder trust for the building and have to live on $660,000 for the rest of your life? Kind of a no-brainer, isn't it? And then somebody will say, oh, golly, Ed, you gave that $5 million building to charity. You just screwed the kids out of part of their inheritance. Not so fast. Since the IRS allowed us to bypass the taxes on basically everything here, maybe a couple of dollars we pay in tax, but because we have an extra $180,000 to work with, Let's carve off a little bit of that money and buy a life insurance policy to replace the $5.5 million building. And we want to park that life insurance policy in some type of life insurance trust, dynasty trust, or something that has a degree of asset protection and estate tax, exemption with it. I mean, the reality is I just had the IRS pay for this life insurance policy, didn't I? And so I subtract $55,000 from the 660. Oh, Mr. and Ms. Smith going to have to live on $605,000 a year instead of $441,000. This works all day long. No tax planning, that's their lifetime income. With the charitable remainder trust, that's their lifetime income. When we look at the distribution of the estate plan, when it goes to the family, assuming mom and dad left the investments alone, only pulled off the growth on the personal side of the plan, let the life insurance do what it's supposed to do, let the CRT do what it's supposed to do. The kids inherit $11 million tax-free because of the step up in basis rule. Hopefully will still be here when they die. Charity picks up $7 million. Basically, this strategy creates $18 million of wealth control, a benefit of an extra $7.3 million had they did no tax planning at all. And it just so happens John and Mary Smith, their son has traumatic brain injury. That's the reason why when we saw on their tax return, they were making these $50,000 gifts to their local hospital. When we started asking about the gift and what was going on, and they shared the story on how their son had TBI, they then wanted to make certain that in perpetuity, they could bless their hospital with a gift. So they set up an endowment to receive the CRT funds, which will do this. Now, I will tell you from experience, and I'm certain the folks like Liz and Andrea over at the hospital will tell you the same thing. Whenever somebody does a structured gift like a CGA or CRT or a lead trust or something like that, they will continue to make current gifts. So even though there's this big fat CRT for $5 million, even though there's going to be an endowment funded, overwhelmingly and statistically, John and Mary are going to continue to make current gifts to that hospital. And you can bless your church, arts, homeless issues, anything that's a 501c3. So in effect, just a moment ago, I talked about engineering social entrepreneurship. Did we just accomplish this? And I have to tell you, we accomplished this using two safe harbor tools that have been around forever and ever. They're tried and tested. They're relatively simple for people who have the experience and deal with these things all the time. If you've never done a charitable remainder trust or an ILET or anything like that, I would beg of you not to do it by yourself the first 2 or 3 times. I would encourage you to have co-counsel work with you to get it designed the best way possible to accomplish the objectives. I can't tell you how many times somebody will bring me a charitable remainder trust for somebody that's 61 years old with a 17% payout. My first question is, how did you pass the 5%, 50%, and 10% test? And the attorney will look at me and go, what are those tests for? There's actually some rules on these charitable trust thingies, okay? So reach out to experienced counsel. Have you done these? I have a client. Will you help me do this? Here's what's going on. You got to cut your teeth on something. I just beg of you, don't be testing your malpractice license because you got an ego issue. And I'm not trying to say attorneys have an ego issue, whether you're a financial planner or CPA or whatever. I beg of you, with something sophisticated like this, collaboration is the key to being successful with these things. Okay. Had a case in Southern California, gazillion-dollar case. Another problem we have with putting real property into a charitable trust is debt. It's not a good idea to put debt encumbered properties into a charitable anything. So what we did was we moved all the debt to one building. We had a cooperative bank. Now that we have 2 buildings that are zero debt, now we're in a situation where we put one building in a charitable trust. Then we ran the calculations on the second building to do a part CRT, part sell. In other words, what's the ratio so that the client on the second building can sell that building with maximum tax efficiency and theoretically go home with a zero tax transaction. It gets a little complicated, but if you just start helping the client talk through these things, they're like, wow, this is pretty cool. I know how to make that work. I've only been doing this kind of work now for about 20 years when I went to that fancy dancy school back in Indiana. And what I've learned is that in order to be the best advisor, you just have to be an expert at all of these things. And that's impossible. You can be an expert in a handful of things, but what I do is I look for those brilliant planners around the nation that are good in specific things. Like, for example, who's the best dynasty trust person that I know? Who's the best ESOP person? Or the best, by the way, if you've never heard of a charitable fractional ESOP, oh my gosh, those things are just hammers. Who does the best flip CRUT? Who does the best captive insurance structures? And that's what I do is I try to find talent. And then when I'm in front of the client doing the analysis of, all right, what's important to you? What are your objectives? What's the nature and character of the asset that we're dealing with? How are we going to get from here to there? What are the tools and strategies that make sense? So for example, I got brought into a case down in the South Bay, San Jose area. It's a $26 million business, 3 shareholders, dad and 2 kids. And the basis is like nothing. And the tax bill is $9.3 million if they do nothing at all. And it's an unsolicited buy, but basically the daughter, who is just a brilliant CFO, when this unsolicited offer showed up, they were perfect. They were ready to go to market and didn't even know it. It was just the way she was about how she ran those books and the policies and the company. I mean, it was as if she was the business coach. She was there and it was great. So an unsolicited buyer walked up and literally offered them more than what the value of the company was, which was a great thing. But then they're like, look at this $9.3 million tax bill. And so what I did was I went in with 4 different solution sets for them to explore. And my job is to really be the facilitator here. We did the analysis to figure out what made sense in respect to the asset and their objectives. And then when I laid out the 4 different solution sets, they were able to go, this one is our primary choice, this one is our second choice, this is our third choice, and we just don't like that other one at all. Do they need to know about all these things? They don't. They just need to know, do you have the best people in the country helping get this thing done? Does it have safe harbor? Do you have opinion letters as necessary on some of the things that sometimes we need to get, and to help them get there? Because I truly don't know of anyone who's an expert at all of this. But I do know how to find the people that are. And what I'm soliciting tonight is look for people that do things that you don't do and build a relationship with them. Okay. I talk about in my book how to manage a 1040. I don't spend a lot of time on how to make the money or the deductions or contributions to Roths and IRAs and stuff like that. But I do spend a lot of time teaching that charitable retirement planning is probably the best kept secret that no one's talking about, because we see that word charity and we immediately think that if I talk to my client about something charitable, they're probably going to show me the door. I would encourage you that the strategy we talked about earlier about giving poorly performing appreciated stock to charity in lieu of cash, that will open that door so that once you've done everything you can with all the solutions you have, and then you look at Schedule A line 14 and you still see an opening there of 30% or 60% of their AGI, this is when your conversation changes. Imagine creating a superior retirement income strategy for your clients beyond the standard issues of just maximizing a pension plan. Integrating a charitable retirement plan, the numbers just get crazy. Helping clients understand how to sell a business or a major asset without losing so much of the value in taxation. Overwhelmingly, when you give people a choice, we're going to give $3 million to the IRS or $3 million to charity. Which one would you like to do? They will choose charity. Transferring more money to the kids. double-edged sword here. I like what Warren Buffett and Bill Gates and a lot of the other people are saying about transfer of the wealth. They want to give their kids enough money that the kids feel like they can do anything, but they don't want to give them so much that they'll do nothing. To me, that's really important. And being able to balance that wealth transfer in such a way that it has the highest degree of asset protection is really important. The other thing that I'm finding more and more people, particularly first generation millionaires, which we have a lot of here in California, we have a disproportionate number of first generation millionaires out here, helping them begin the discussion of cascading wealth and cascading legacy models. Here's $15 million that's going to go to little Johnny. If we protect the $15 million and make certain little Johnny's taken care of, there's a good chance that $15 million in his trust fund is still going to be there when he dies, that then goes to the grandchildren. There's power in that. I worked at a litigation law firm where we had this elderly couple come in and their son had stolen all of their money. But we found out he was married to one of the richest women in California. And we were like, Yahoo, I can't imagine what the contingency is going to be on this puppy here when we sue her. And I was dispatched to go basically do a little reconnaissance and found that she was living in a $14 million house and had $2 million of cars in the driveway. And I get back to report to the boss that, hey, this is going to be great. But when we started doing the deep dive and found out that not a single bit of that was in her name and it was held in trust for her benefit, we couldn't do a thing. And she was fourth generation. And I can't say the family's name because you would know them. But the reality is we really have to help clients understand that how do we transfer wealth tax efficiently? And one of the questions I keep getting about the Biden tax proposal, they call it the 99.8% Tax Act. How is it going to translate going forward? It's going to be more tax. And I preface that with, it really doesn't matter who the president was going to be. After COVID and the impact that it's had on the globe, we have to find a way to create more revenue. And there's just no way around it. People who make more than $400,000 a year, they're definitely going to feel it. I think we're going to see some capital gains changes. The proposal right now is kind of high at 1,039.6. I don't know if we're going to see that high, but that's the proposal. The estate tax dropping down to a lot lower number. I personally believe 3.5 million is too low. I think adjusted for inflation, the estate tax number should be somewhere between 5 and 6 million. Hopefully the Senate will kind of weigh in and balance that number out for us a little bit. But regardless, income tax planning is still going to be the priority. Capital gains tax planning in California, because it seems like everybody's leaving, there's going to be a lot of transactions. So we really need to be paying attention to what are the tools that we can bring to the client to handle their income and capital gains issues, while at the same time being respective to the overall estate plan and making certain that we are able to transfer things properly to the children with the greatest degree of asset protection. And introducing the concept of a legacy plan. Most people, when given the opportunity to talk about the charities that are important to them and why. I mean, it's amazing. I sat down with one lady one time to ask her, you're making this great gift, but I need to know why you're so motivated to do this gift. And she's like, well, I love dogs and cats, and I want to help out the animal shelter, but I don't want to go to the animal shelter because I know what happens there. But I want to be involved somehow, more than just writing a check and giving them a bunch of money. And so I went over and talked to the director and I said, are there any types of jobs that this lady could do for you to have a deeper connection? Remember, donors are looking for that relationship, that connection. And so what we found is that 2 times a week, they had to go to the feed store to get the food for the animals. And so we had her volunteer to drive the truck over to the feed store. They loaded the feed in the truck, and she drove the truck back to the animal shelter twice a week. To her, it was the most important thing of her life. It was the greatest self-actualization of anything she'd ever done. And so that's the value that we advisors bring to the table to help them capture that feeling of knowing that every night when they put their head on that pillow, because of us, they're able to close their eyes knowing the impact that they make right now and for the rest of their life. That's our value because of you. And so what I'm hoping in our little bit of time tonight, that we've been able to share a couple of concepts that I try to help open these doors for discussion with families. And if you only take away the one concept, that when you look at your client's tax returns and you flip over to Schedule A and you look at line 14 and you're seeing they're making a gift of $10,000 or $50,000 or $3 million to worthy charitable organizations, open up that discussion about the tax efficiency of giving those poorly performing, highly appreciated securities or real estate first, and then replenishing those accounts with the cash that they were going to give to the charities anyway, as a way to show them how to make charitable giving profitable. And I will promise you, it will open the door to other discussions that it's blown my mind. It is the most satisfying thing. In the last 20 years, I've been personally involved with $372 million in charitable gifts that I know of. And it just does my heart a tremendous amount of good to know that. Now, I do have a goal of $5 billion to donate to charity. And so I figured that tonight, since most of you folks down in Santa Rosa are bazillionaires, if all of you could write a check for at least $100 million, I could be directly and responsible with you tonight of hitting my goal of 5 billion. And so do we have any volunteers? I think Chad said he could stroke a check for 100 mil. Michael maybe could do 100 million. Anybody else can weigh in here and do maybe 100 million with us. Hopefully that's the goal. But what I'm really trying to be serious about here is that, folks, this charitable planning stuff is a hoot. When we get away from the numbers, when we get away from the rate of return, when we get away from the product does this, when we get away from the design of the trust, and we start talking about the why and the reasons that they're doing these things, I think we can have a lot more fun than what we're doing right now. And so I'm going to hit the stop share on this thing so we can go back to the regular screen here. And it's not responding. So I'm going to go over here and kill the PowerPoint. Give me just a second, please. There we go. And Josh, you have the microphone.
Hey, well, Ed, thanks. That was awesome. Very well done. Of course, for everyone on here, I'm open to questions. I'm comfortable if you just want to unmute yourself, or if you feel more comfortable, type them into the chat here. Go right ahead. I just wanted to add, Ed hit all the key points, but I think right now in where we are with highly appreciated assets, with run up in the stock market, run up in real estate, we really, as a group of advisors, have an opportunity, as Ed is explaining, to really help our clients and pour millions of dollars into charities. And the highly appreciated real estate right now is a big one, as well as stocks. Those of you that have the opportunity to work with, IPOs that sort of pop and you get a snowflake and now they're multimillionaires overnight. And that's another thing. I have a case I got brought in on that for some snowflake employees. So there's a lot of opportunities out there just to have the tools to do it. So any questions, comments, adding, thoughts, anything that about charitable planning?
Ed, this is Chad. Unfortunately, I won't be able to stroke that check for you, but I was wondering if you had thoughts. I have a couple of clients who are considering creating their own foundations so that they can set up, they don't necessarily have one cause that they want to give to, but they want to be able to give it to a 501c3 foundation, and then they and the board of the 501c3 then plan the giving out through the generations ostensibly putting his kids on the board and that sort of thing. Any thoughts on that?
Yeah, Chad, you've asked a very important question, and a lot of times it's a blend of foundations. Um, One, there's a corporate foundation base where the business is doing their philanthropy corporately. There's the personal family foundation piece, which could be anything from a private foundation to a donor advice fund type thing. And then you've got the legacy type foundation like the Kennedys and those types of families have done. I typically find for your higher net worth families, you end up with all three. Okay. And the other thing that I find that works very well is introducing the kids to philanthropy at an early age. Let me get back to your question, but one of the strategies that I use with my clients when they first realize, oh my gosh, we could be doing so much more and doing something for the community and having fun. And so they'll always say, well, how do we get the kids involved? Well, it's real easy. Do you guys get together for Thanksgiving or Christmas? Uh-huh. I said, all right, so here's what we're going to do. We're going to send a letter to the kids and the grandkids telling them that when they meet at grandma's for Thanksgiving, that we're going to have a little contest. And grandma and grandpa need help giving away $50,000 to a charity, but they want the kids and the grandkids to come up with the charity. And each person is challenged with coming to the meeting to talk about which charity they have picked, because what we want is to have all the kids and grandkids making a contribution about the charity they think should get the $50,000. And oh, by the way, let's put a carrot on the table. For the kid that presents the charity that the family votes on to give the $50,000, let's give that child some type of award, be it cash or something of that nature, to start teaching that affluence at a very, very young age. Because one of the things that I've been seeing, because on the East Coast, we have 7 generations of wealth transfer. So we see that generational wealth legacy model with the foundations you're talking about. But the kids have to be trained for that responsibility. And so these are some of the little tools that you can start integrating so that the families can do this. As one of the technical rules in private foundations, I know I'm going to get some disagreement with this. I personally don't think that a private foundation should be established unless we're funding it with $1 million on day one. If it's a number short of that, I want to see them start with a donor advice foundation, like at the local community foundation or Schwab or Fidelity or something like that, so the family can get used to the technical things involved with a charity. Once they have enough money to do the private foundation, to have the expense of running it, to have the training, to have the accountant and the CPA that can be there to help them guide through that, that's when it, to me, starts making sense. And then balancing the corporate foundation too. I've got a company right now, they're just making so much money, it's ungodly. And they have a foundation and it's been sitting there for 4 years and they've never put $1 in it. So that's one thing. Another thing, I just had this happen yesterday. A guy lost his son in a terrible medical scenario. He was 13 years old, and they went out and set up a public foundation, and they raise money and give money away. And I'm like, I'm glad to hear you got a public foundation. Tell me about your donor base. Well, it's just me. I'm like, so you're the sole donor for the charity that you set up. And my question is, how are you going to pass the public test if you ever get an audit? He said, what's a public test? And so that's why I think that these donor advice funds are what I think are safeguards for a lot of people until they can get the information they need to understand the duties and responsibilities having a private foundation or their own 501c3. I think it's powerful to do. And I'm here to tell you, whenever you can see that happening, Chad, there's something going to happen. It's just which makes sense along the way.
Okay, thanks.
Yes, sir. Is anyone else going to renege on writing the check for $100 million? I mean, I can't count on everybody else, right? I mean, Chad's the one bailing out on us here.
Well, if there's no other questions, I will. Oh, someone just came in here.
Can I make one pitch for the charitable gift annuity thing yet?
Go for it. Yeah.
Deferred flexible charitable gift annuity. It is a hammer. You can do these things for like $10,000. It's not something for the money manager to make any money off of. I'm sorry about that. But that donor who makes $130,000 a year, who's an employee, who's already funded their whole IRA with what, $8, and they're still looking for tax deductions, the deferred flexible charitable gift annuity, in my opinion, is the unsung hero for the W-2 wage earner making less than $400,000 a year. They can go to the charity, stroke a check. It's a 2-page contract. They do get a deduction as a deferred gift. It does help that. And they can actually say, I want to defer the trigger mechanism. So they get a deduction based on life expectancy, et cetera. And then down the road, when they're ready, they call the hospital and say, hey, I'm ready for the income stream to start now. Here's a letter. And they start getting a check from their deferred flexible gift annuity, which augments their 401k, their Social Security, and everything else. It's just another retirement bucket. It's a simple one. It's an easy one. And for W-2 wage earners, I think it is the unsung hero today. Can I get an amen from the hospital, Liz? All right, that's all I got.
Well, hey, thanks again, Ed.
Amen.
Oh.
Amen. I couldn't get in there fast enough. Yeah.
Yeah, so thanks again, Ed. Always a pleasure to work with you on cases and, of course, listen to you speak. So thank you. Do we still have Ken, or did he? I know he's traveling. I'll just close it down then if Ken's not here anymore. So next month we have Wells Fargo Trustees Tale. And for everyone, enjoy the rest of your night, and we'll see everyone next month. Thanks a lot, Ed.
Good night, everybody. It's been my pleasure.